big week ahead with the Reserve Bank official cash rate decision on the same day as the federal budget. And after the shock fall in CPI and core inflation, a rate cut is clearly back on the table for Tuesday. We still think rate cuts are more likely later in the year, and the RBA has been quite clear that it sees monetary policy as less effective at current levels compared to normal times. But the inflation figures have been described by some economists as a game changer. The low consumer price index, below 2%, is something we've become accustomed to. But the RBA's preferred measures of core inflation, the weighted median and trimmed mean, were this time also around 1.5% annualised. And for the quarter, CPI was actually negative. So, all well below the Reserve Bank's target band for inflation and their latest forecasts. The market reacted by placing a 55% probability of a rate cut on Tuesday, which might be a slight overreaction, but deflation is as much a concern for central banks as rampant inflation, and a rate cut is considered one way to try to lift the rate of inflation to encourage spending now rather than deferring retail purchases. The RBA won't be influenced by the timing of the federal budget. If they need to cut rates, they will. But they don't have much monetary ammunition left, so won't rush to impart further pain on savers and risk further imbalances in housing markets. Meanwhile, what can we expect from the federal budget? Obviously, we won't be seeing a budget surplus this year or any for the foreseeable future. But the recent recovery in the iron ore price might see less revenue write-downs than would otherwise have been the case. Other key areas of focus will be any changes to superannuation rules, particularly for higher earners, tinkering with corporate tax rates, and infrastructure spending. Overall, debt levels will rise a little, but the peak in net general government debt should still be no higher than 22%, well below the 30% level that ratings agencies have warned could risk our AAA credit rating. Beyond this, it will be interesting to see how the Aussie dollar responds, having rallied to above 78 cents, but then knocked back down to 75 with a low inflation read, and also how business confidence responds to the federal budget. Last year there were plenty of incentives for small business. We'll see what is on offer via the budget this year, or whether some of those sweeteners might wait until later in the pre-election build-up to July the 2nd. I'll see you next week for the market update from Bendigo Bank.